Special situations in lower middle market. This is what I want to cover today. And there's one special person who I haven't met. I've invited him to the podcast once. He respectfully declined and said that he's just too busy. Back then, I knew he was raising a fund. I've heard he did it successfully, so now he's probably deploying the capital. But he's the guy when you want to learn special situations because he has seen a lot working for various operators, done many deals, and he has attended to one podcast, which was Invest Like the Best with Patrick O'Shaughnessy, and I was listening to this. I've listened to that a few times. Then I've always said to people that I'm very happy that I found this person in internet. It's very easy. You can learn from them. And I'm very happy that I was able to do that when I was like 32, which I am today, and not when I'm in my 50s, because I would have missed a lot of opportunities. I would think differently, etc., etc. Jeremy Giffen, he was a guest in an Invest Like the Best podcast with Patrick O'Shaughnessy, and he's pretty active. Again, once in a while, there are different periods. For 3 months, he's posting a lot on X, and then he's just disappears, goes back to work. And you can find a lot of interesting things on him and how he thinks about the business investing. And I believe it's very rare. And I have here like almost 10 pages of different notes. And this is what I want to cover today because, again, I've said it before that he's such a clear thinker, I believe, at such a young age. So when we read about different investors, world famous ones, they're in their maybe 50s, 60s, 70s today, it's oftentimes very hard to find something when they were like in their 20s, in their 30s, how they were thinking, what businesses they were buying, what opportunities they were looking for. You can do it by reading books, but you can't really hear their voices because there aren't any interviews with them. It's very rare. But in these days, it's beautiful. You can find someone at such a young age, thinks differently, has done many things, has acquired many companies, and you can really see where they're going. And it's going to be very interesting to see where these people end up in 20 or 30 years. That's why I think we have this rare opportunity in these days by actually we can learn from those people and just implement those things in our own world of buying businesses, operating businesses, deploying capital, and partnering with other people who are on a similar journey. And that's why, again, 9 pages of notes. Let's get started because these ideas are I would say, refreshing when it comes to investing, buying, and operating businesses, that this is something I go through again and again because this stuff is timeless. And for years, he stayed behind the scenes, executing brilliant deals that most people ever see. He's not out there seeking attention. He's in the background, quietly spotting inefficiencies, solving coordination problems, and at the same time making a ton of money by understanding human behavior a lot better than many people do when it comes to investing and buying businesses. Giffen, he was a general partner at Tiny, which is a holding company that buys and holds internet and technology-based businesses. Before that, he was on the founding team of MediaCore, which got acquired by Workday. But none of this is why we are talking about him today. We are talking about Jeremy Giffen because the way he thinks about business, as I said, about investing, and probably most importantly, about human psychology. He's the guy who doesn't look at the business and ask, how can I make this better? He asks, why does this opportunity exist at all? He's an expert at identifying mispriced assets and inefficiencies that many investors overlook. One real-world example is how he has spoken about acquiring businesses where the owner was forced to sell due to structural constraints, such as when a founder's personal life, for example, could be divorce, estate issues, or health, creates a very rare buying opportunity. And he's a master of special situations where capital constraints, founder fatigue, or structural market shifts create asymmetric opportunities. And in one podcast, Jeremy discussed the case of a startup that had raised too much venture capital and was unable to meet investors' expectations. And while VCs saw it as a failure, he saw a profitable business hidden under layers of misaligned incentives and restructured the company to operate efficiently without outside funding. He's a deal maker who thrives in blind spots of traditional finance, turning orphaned businesses into cash flowing assets, which a great example is how tiny capital were acquired profitable but neglected internet businesses from large corporations that saw them as non-core assets. These businesses, while overlooked by original owners, became cash machines when placed under proper management. Today we are going deep. I'm going to walk you through all the lessons Jeremy Giffen has shared, but I'm not gonna just list them out because I wanna really you to understand and really like feel them on how he thinks, and we're gonna really get into inside his brain, and by the end of this episode you'll understand how he sees the investments and opportunities he pursues. So let's dive in. Lesson number 1 is, what is the perfect business? Which is, what if you could speak money into existence? Private equity firms and investment groups all define the perfect business very differently, depending on their strategic goals and investment thesis. For example, when you take Blackstone, the world's largest alternative asset manager, often looks for businesses with high recurring revenue and strong pricing power. Their 2007 acquisition of Hilton Hotels for $26 billion is a very classic example. By restructuring the business and leveraging its global presence, they turned it into a massive value creator before taking it public again in 2013. KKR, another private equity giant, often pursues businesses with strong operational improvement potential. Their investment in Gardner Denver, which is a manufacturing company, was really like a textbook leverage buyout where they focused on improving margins and operational efficiencies before successfully exiting. Or if you take Berkshire Hathaway, prioritizes long-term cash flow stability and simple businesses. Warren Buffett famously bought Seascandy for $25 million in 1972, not because it was growing rapidly, but because it had incredible pricing power and brand loyalty, making it a compounding machine over time. Every firm has a different idea of the perfect business, but Jeremy Giffen's approach stands out because it focuses on asymmetry, finding businesses that others overlook or misunderstand, and extracting value through simplicity, leverage, and access. Jeremy's idea of the perfect business is very simple. You get paid an absurd amount of money for your words alone. There's no inventory, no logistics, no capital expenditures, just wisdom that people will pay millions for. And what are some of the examples? Think about old school merchant banks. Think about Lazard. Think about Allen & Co. This is a business model based entirely on leverage. You just need people who trust your judgment so much that they will cut you a check just to hear what you think. And what is the best part? These businesses don't just generate cash, they give you access. If you're in the right rooms, you are not just advising on deals, you're investing in them too. You're compounding inside the machine. A great example, as I mentioned, is merchant banks like Allen & Co., a firm that has spent decades embedding itself in the most elite business circles. Rather than just advising on deals, they take equity stakes and get seats at the table, ensuring they benefit from the upside. Another example is how Sam Zell, the legendary real estate investor, used his network to consistently access off-market deals that no one else saw. His philosophy was very simple. Be where the deals happen and always have the capital to move quickly. Jeremy once tweeted, "The highest leverage business is being a trusted thought partner to people who control capital." That's it. That is the entire game. This business model is so powerful that very few people will ever have access to it. But if you can get there, it's a game changer. Now, what is the perfect investment? And what Jeremy have said, coordination problems are where the money is. He doesn't invest like most people. Most investors focus on assets, which is the business, the product, the financials. But what Jeremy does, he focuses on circumstances around the deal. He doesn't ask, is this a good business? He asks, why is this available to me? That's the key. If a business is up for sale, there's a reason. Maybe the founder is getting divorced. Maybe the VC firm needs to clean up their portfolio before raising their next fund. Maybe there is a tax law change coming that forces an owner to sell. And Jeremy also tweeted, I want to buy from forced sellers, not willing sellers. You don't need to be a genius about the product. You just need to understand why this opportunity exists and whether you're the person who can unlock the bottleneck. A great example of this is when Jeremy described the deal where he bought a niche software company that had been neglected by its corporate owner. The product itself was solid, but had been underfunded and mismanaged. And instead of diving deep into the technology, Jeremy focused on why the business was being sold. The parent company wanted to streamline its operations and was shedding non-core assets. This was an opportunity for a buyer like Jeremy to acquire a profitable business at a steep discount simply because it no longer fit the seller's strategy. And by stepping in and providing minimal operational improvements, he unlocked substantial value without needing deep product expertise. These deals happen all the time. Health issues, retirement, divorce, estate planning, while each creating a scenario where a great asset is available for reasons unrelated to its core value. That's the kind of opportunity Jeremy Giffen seeks out. Another situation is where VCs and founders speak different languages. One of the Jeremy's favorite plays is what he calls ghost ship companies. Here's what happens. A startup raises too much capital, they build a real business, could be 10 million, 50 million in revenue, but it's not the hyper-growth rocket ship their VCs expected. The founder realizes, I will never make money from this company. The investor realizes, this is a dead end for us. But nobody wants to admit it. So the company keeps burning cash, existing in limbo. Jeremy once wrote, the best assets in the world are unloved, orphaned, and misunderstood. One of his favorite examples of this comes from a software space where he found a company that had great recurring revenue but was abandoned because its VC backers were only interested in $1 billion outcomes. The company wasn't failing, it was simply not a hyper-growth business, and then Jeremy stepped in, restructured operations, and turned it into a sustainable cash-flowing asset. Another fascinating example of special situation in investing is what happened with Michael Dell's buyout of Dell Technologies. In 2013, he saw an opportunity to take the company private for $24.4 billion, restructuring operations outside the public market scrutiny. And 5 years later, he took Dell public again at a significantly higher valuation, proving that sometimes the market undervalues assets purely due to short-term pressure. Another example case was Vista Equity Partners' acquisition of Marketo, a SaaS company that had plateaued in growth under public market pressure, and Vista took it private for $1.8 billion, focused on operational efficiencies and product improvements, and sold it to Adobe just 2 years later for $4.75 billion, which is a massive return on investment. This was a textbook case of spotting an orphaned but valued business and repositioning it for long-term success. But these opportunities aren't limited to tech and SaaS businesses. Traditional businesses present similar special situations. Consider family-owned manufacturing companies where the next generation has no interest in running the business. A classic example is when private equity firm Clayton, Dublier and Rice acquired Hussmann, which is a refrigerating equipment manufacturer from Ingersoll Rand back in 2011. The business was non-core for Ingersoll Rand, and CDR, the private equity firm, they saw an opportunity to modernize operations and streamline the supply chain. And just 5 years later, they sold it to Panasonic for $1.5 billion, netting a significant return. Another example is the restaurant industry, where aging founders sometimes hold into great businesses for too long. In 2015, Roar Capital Group acquired Buffalo Wild Wings for $2.9 billion, recognizing that the chain had strong brand equity but had struggling under public market pressure. With the right operational focus and marketing revamp, Roar turned it into a high-performing asset. And this just shows that if you know where to look and how to structure a deal, whether it's in software, industrials, or food services, special situations exist across all sectors. And in Jeremy's case, this is where he thrives. He goes in, restructures the company, and turns it into a profitable business without all artificial VC package. Special situations are great, but there is another lesson, which is patience and selectivity. And great investors can sit on their hands for years. Very quick pause. The best investors I know are ruthlessly selective about what they own. They don't want to blind pools or capital deployed on someone else's timeline. They want to evaluate deals one by one, understand the operators, and build a portfolio that actually fits their thesis. And that is why deal-by-deal investing is so powerful, and also why it's historically been hard in the lower middle market. It's accessing high-quality opportunities in that 5 to 20 million enterprise value range, because it usually requires deep networks or institutional-sized checks. But that is what CapitalBat solves. CapitalBat curates acquisitions from searchers and independent sponsors. They handle the upfront vetting and bring those deals to accredited investors with minimum starting at just $25,000 per deal. You're not buying into a fund, you are choosing individual businesses, which are real companies, real operators, and direct ownership. It's an infrastructure built for investors who want access to established private businesses without institutional minimums or blind commitments. If that sounds like you, check them out at capitalbat.com. I'll also put the link in the show notes. And now back to the show. Jeremy once said that he knows an investor who went 6 years without making an investment. It's 6 years, right? Such a long time. But here's the thing. When this investor finally pulled the trigger, it was a legendary deal. And this is very similar to Charlie Munger's approach, which is the big money is not in the buying and the selling, but in the waiting. And Jeremy has said, if you're doing deals just to stay busy, you are going to underperform someone who waits for the fat pitch. And patience is one of the hardest yet most valuable traits in investing. A great example of this is Henry Singleton of Teledyne, who famously refused to make deals when the market was overheated, but aggressively bought back shares and acquired companies when they were deeply undervalued. His disciplined approach turned Teledyne into one of the most successful conglomerates of its time. Another case, obviously, Warren Buffett's refusal to invest during the dot-com bubble, while others rushed into overpriced tech stocks. Buffett sat on the sidelines, waiting for valuations to make sense, and when the bubble burst, he was ready with capital to deploy at much better prices. Even in private markets, patience really pays off. Jeremy has talked about investors who wait for distressed assets, companies forced to sell due to debt maturities, personal issues, or economic downturns. The key is to wait until the seller needs liquidity rather than chasing deals for the sake of being active. What is the big lesson here? It's if you don't see a great deal, don't force it. The right opportunities will come, but only if you have the discipline to wait. Which leads me to negotiation. LOI 25 million and the Ferrari 488. Negotiation is an art, and Jeremy really believes that most people fail at it because they negotiate against themselves before the conversation even begins. He points out that many people assume they can't ask for something or that an offer would be too bold, and they just limit themselves before even trying. They do it all in their head, and in reality, very few offers truly offend people to the point where they will walk away. The key is to make offers that others won't or can't make. And a great example of this is a deal Jeremy came across where a business owner was weighing multiple offers. This person had already made tens of millions, so it wasn't really about the money anymore. And Jeremy and his team noticed something very interesting. This guy was obsessed with Ferraris, but due to social expectations, his wife, or just maybe his own reservations, he would never justify buying one for himself. So instead of a traditional bid, they structured the offer as 25 million and the Ferrari 488. Why not, you may ask? There are no rules saying on your LOI that you can't include creative terms. And in the end, that offer stood out because it solved both a financial and an emotional problem for the seller in a way no other bidder did. What is the huge takeaway? Think beyond numbers. And sometimes structuring a deal around what actually motivates the seller, whether that's a specific asset, ongoing involvement in the business, or an emotional win, can get you a deal that others miss. Few ideas on how Jeremy thinks. He once tweeted, "Everything good you want in life is on the other side of a single phone call that you're absolutely terrified to make. You know exactly who it is, and you know exactly what you need to say, but instead you let it haunt you for years." This underscores his belief in decisive action, whether it's negotiating a deal, reaching out to a potential business partner, or resolving a conflict. The best opportunities often come from taking that uncomfortable step forward. Many great investors and deal makers have built their careers by making bold calls at the right moments, such as how Sam Zell structured off-market real estate acquisitions through very direct cold outreach to owners. And Jeremy had shared 6 unconventional truths that really define his approach to business and investing, and I want to break those down to you. Number 1 is all general advice is bad. The best decisions are context specific. Jeremy often talks about how some rules like always buy real estate or never do small deals, they're simply too broad to be useful. And instead, he emphasizes understanding the unique variable in each deal. A great example is how he found opportunities in SaaS companies that were overlooked by traditional VCs because they didn't fit the typical growth at all costs model. And by seeing this, they were able to do those extremely attractive deals. Another one, napkin speed spreadsheets. Overanalysis kills good deals. Jeremy believes the best investments can often be summed up on a napkin. If you need a complicated model to justify a deal, it's probably not a great one. Warren Buffett echoes this philosophy, as he was able to evaluate See's Candies in minutes based on its pricing power and brand loyalty rather than complex financial projections. You can tweet your way onto a yacht. Leverage isn't just financial, it's social. Jeremy has discussed how modern investors and operators can use the internet to build relationships and gain access to opportunities they would have never encountered otherwise. A very great example is how entrepreneurs like Alex Hormozy and his own partner Andrew Wilkinson have built multi-million-dollar networks simply by sharing valuable insights online. Take Twitter, for example. Another thought, if you're making a pro and con list, you've lost. The best decisions are obvious. Jeremy believes that if you have to debate a deal endlessly, it's probably not the right one. Buffett and Munger concept of the too-hard pile follows the same logic. If it's not a screaming yes, it's a no. And great investors act quickly when they see an asymmetric opportunity. Quarterbacks envy nobody. Jeremy explains that as people get closer to doing the work they are truly called to, the things that make them envious start to disappear. Many ambitious people, particularly those from elite schools, justify their career choices by putting down others' success. But someone who has truly found their calling simply doesn't feel the need to compare or criticize. He illustrates this by saying that when he sees an NFL quarterback, he feels nothing. No envy, no judgment. He doesn't think that could have been me or that guy isn't even that good. It doesn't even cross his mind. On the other hand, when he sees a 20-year-old founder cashing out for 600 million, he still finds himself rationalizing, well, he didn't really own much of this company or that business isn't real. That's how he knows he hasn't fully eliminated envy yet. And the ultimate goal, Jeremy says, is to reach a mindset where everyone is a quarterback, where you can see someone else's success, acknowledge it, and simply say, good for them. That's not what I want to do, but I'm happy for them. Truly locked-in individuals don't waste time envying others. They focus on their own game and they just execute. If you take one thing from this episode, what I took was, you don't need to be a genius to win in investing. You just need to see the game differently than everyone else. And Jeremy himself doesn't invest like most people. He doesn't try to outsmart the market with complex analysis. He looks for a simple mispricing of reality, and he asks questions many people never even consider, which is, why does this opportunity exist? What incentive misalignments are causing this situation? And can I be the person who unlocks this deal? If you enjoyed this episode, share it with someone who might find it valuable as well, so you can get those conversations going. I did this and it definitely works. And again, if you took one thing from here, it's you don't need to be a genius to win in investing. You just need to see the game differently than everyone else. Again, I hope you enjoyed. The best opportunities aren't found, they are created. So go create one. See you next time.